Okay, before we head in to the market outlook this week, I had already put a video up last week telling you that I had made one of the videos from the applied level free for preview in case you're wondering what the content would look like, what you would get. The first link in the description box below will get you to this page. It's a free preview. I put one video up, Understanding Gold Mining. It's an hour and 43 minutes long. So that is free if you want to have a look at it. Again, first link in the description box. Well, let's start with Q1 GDP. Came in at 1.6%. Expectation was 2.5%. Breaking down the components, C plus I plus G plus X minus M. The consumer, 1.68%. You got to go back to Q2 of 2023 to get that low. Q3 and Q4 were both over, contribution was both over 2%. Investment 0.56, fixed investment 0.91. Good solid number both in non-residential and residential. Nothing to complain about here. You had a drawdown of inventories in Q1, so it took away from GDP because it measures goods produced within the economy over a period of time. If you're drawing down inventory, this is goods from another period. But the argument could be made that, well, an inventory drawdown in one period means an inventory build in a future period. G at 0.21, and this hurt the trade balance. But a strong US dollar is going to do that. It will increase the price of your exports and drop the quantity of exports, and it will make imports really cheap. And there you go. So some of the consumption over here and some of the spending on investment was from goods that were produced, goods and services produced from outside the country. Goods 0.74, services 0.22. This is somebody else's GDP. And that is somebody else's, if we follow the identity that GDP equals GDI, which is gross domestic income. This is somebody else's income. Non-Americans, that's a leak in the bucket. That is wealth that is leaving the country. With the unemployment rate the way where it is, with really low unemployment, and every month since September, October, November, December, the economy's been adding jobs all the way through Q1, been adding jobs, and we've looked at the employment cost index for Q3 and for Q4, both positive. We're going to get the employment cost index this week for Q1. I expect that'll be positive. That you're only getting 1.68 towards consumption, with the consumer in the first quarter of 2024 having more money than they've ever had in any of the other quarters, and only squeezing out 1.68 seems rather curious. But the interest component, how much interest consumers pay, has also been increasing as well, because you have credit card balances that have been increasing as well. And you have, you can see the stress because you do have delinquencies in, I think it was auto loans that I read, delinquencies increasing, and that series is now above pre-pandemic levels, so it is showing up. I find it odd that you have a central bank that is squarely focused on inflation with the statement, inflation hurts everyone, especially those most vulnerable. Now, let me sort of make the argument of what they're doing in a different way. The bottom 50% live with debt. The top 20% typically live with savings, and the top 10%, this is typically wealth, where you have your wealth management industries in the top 10%. Your top 20% is roughly your investment industry altogether, where savings do occur. Bottom 50% is debt. So wealth management happens at the top, debt management happens at the bottom. And what the Fed is saying is, we understand that high prices are a problem, so what we're going to do is raise interest rates to get that down. And because you guys live with debt, we're going to raise the interest rate on your debt, something that you have no choice about, so that we can lower the price of something over which you do have choice. So you can shop around, you can use coupons, you can buy 2 get 1 free, you can buy things that are on sale. There's a lot of choices you can make in the supermarket. You don't have to buy this brand, you can buy that brand. You don't have to buy beef and lamb. You could buy chicken and pork. There's lots of choices you can make to live below the level of inflation. We are going to take that away from you and give you higher debt costs of which you have no choice over. I find it odd that they can make that calculation, that they can do that and say, well, we know that the debt is going to crush you and the bottom 50% live with debt. Too bad, your fault. You should have been more careful, but the high cost of food, the high cost of this, let's see what we can do about getting that down for you, because we know that that hurts. So we're going to substitute something over which you have a choice and give you something over which you have no choice. I think that's a problem. The more damaging part of this report was PCE, excluding food and energy, 3.7% for the quarter. That comes off of 2 quarters at 2%, 6 months at 2%, and then you back up to 3.7. So you're all the way back to the second quarter of 2023. Market-based PCE, this takes the implied costs out. So some items, there is no market price. You have to imply the costs. This series over here says, well, let's just worry about the things that we can see the price on. 2.8, excluding food and energy, 3.1. Again, you got to go back to Q2 of 2023 to get a number high enough. 1.9 and 2.3, 3.1 is higher than that. So this here is the problem. I expect that this is going to sort of set the tone for the press conference. I expect to hear a sentence out of Powell like we have been making progress on our way back to our target of 2%, but much work is left to be done. I don't know that he would talk about rate increases, but just say much work needs to be done and leave it there. Canada, some sobering news on our state of affairs. I say our because I'm still a Canadian citizen, even though I'm not a Canadian resident. Per capita GDP is now 7% below trend. That translates to about $4,200 per person, lower than what trend would have been had we stayed on trend. $4,200. Everyone has got $4,200 less than they otherwise would have had theoretically. We are back to 2017 levels in GDP per capita. So if trend looks like this, basically what we've been doing is Canada's doing this. So we're down 7%, and you got to go back to 2017 to get to that level. So to get back, you have to have significantly faster GDP growth per capita. I'm going to make the argument that that's not going to happen. And even if you get back to trend, you'll always it'll take you 7 years just to get back to the 2024 levels. Per capita GDP is real GDP over population, and Canada has aggressive immigration targets, 500,000 in permanent residents. And there has been some talk, well, they put a cap on students. Yeah, but that's temporary. And they didn't make that number negative. It's still a positive number. It's just not such a strong positive number. They've just lowered the number, but still a positive number. And those are temporary. They come into the country, they stay a while, then they leave. They either come here for school, then they leave, or they come here for migrant work, and they leave, and that's it. But the permanent residents still targeting 500,000 a year. So you have a denominator that's increasing. So if you have a flat numerator, you would get a decreasing per capita GDP. But we do have real GDP growth, just not very strong GDP growth. We have a lack of investment. Canada has had a productivity problem for decades because of the lack of investment. The average capital per worker in Canada is much lower than the U.S. If you were setting up a production facility, you would probably, if you looked at one in U.S. and one in Canada, you could make a very safe bet that the production facility in the U.S. Would be more productive than the one in Canada. And I don't know why, because you can make the decision to provide your worker with the same amount of capital. So there has to be something in the system that disincentivizes investment, or is not incentivizing it enough, you could say. It just got worse. On the last budget announcement, we found out in Canada there'll be a higher cap gains inclusion rate. So the capital gain on investment which is the income on investment is usually capital gain, it's going to be taxed at a higher rate. At the margin, that will lead to lower investment. So what do you do when you have a lack of investment and a productivity problem? Well, of course, like every good politician, make it worse. Let's raise the capital gains inclusion tax. Just to give you an idea of how bad the problem is, in 2023, investment per worker was 20% lower than in 2006. More than 18 lost years on that one. And Canada has significantly lower firm entry rate as a percentage of population than the US. So less propensity to invest in business, in new businesses, less propensity for startups, and less propensity to provide capital for workers. So we have an economy with a productivity problem. When you have that, you usually use policy to incentivize investment, not de-incentivize it by raising the tax rate on the very outcome that it would produce, which is a capital gain. So we do have a government that is unaware, and you can't blame the government. Canadians elected a part-time drama teacher and a less than average journalist. Canadians did that. They did it 3 times. They did it. And voted for the NDP, enough for them to be the support for a minority Liberal government. You voted for people who lacked the resume to make that kind of decision. You voted for somebody and for a party who was far more concerned about wealth redistribution without thinking about wealth creation or wealth preservation. And so what do we have? Well, if you're worried just about distributing wealth and not worried about preserving wealth, which means chasing capital away, I left the country. That is a leak of wealth within the country. Wealth is leaving the country. I'm not the only one, by the way. I'm having been down here for some time. I can tell you, if you saw the amount of capital leaving developed countries, coming to countries like this, regions like Dubai and Singapore, you would be shocked. Norway has this problem as well over the last 2 years because of their wealth tax. Money's been leaving Norway to Switzerland. This is what happens when you have a government that is highly focused on distribution and not focused on creation or preservation. How you get preservation is you focus on wealth creation. Fine, I'll stay in an area that if you're going to restock the lake with fish, I'll keep fishing here even if you take half my fish. I'll keep fishing here because you're putting more fish. But you're not restocking the lake. It's harder and harder to catch fish in this lake. And now you don't want 50% of my fish, you want 60% of my fish. Well, then I'll go fish in another lake, thank you. Now, the US has much higher investment per worker than Canada. The US is, as far as firm entry, I think it's the world leader here, just with the sheer amount of capital they have. So it is a productivity leader. But before you start feeling too smug and too proud of yourselves, have a look at what Biden is proposing for 2025, if of course he's reelected. A higher capital gains tax rate is going to follow Canada down the same pathway. Higher capital gains tax rate. I believe there is a wealth tax thrown in there as well, that if you have a certain amount of money, let's take some of that from you. And if you have a certain amount of wealth, if you are sitting on unrealized capital gains, you don't get to do that anymore. We're going to tax those too. I've made this point before, given the sheer amount of debt that Canada and the US each have. The sheer amount of debt. Now, Canada has lower debt per GDP than the US, but has significantly higher household debt than the US. The American consumer is a little bit better with their debt. Well, I mean, a lot better with their debt than Canadians. And the Canadian government, although they're heading very fast to try to catch up with the US, does have a lower debt to GDP than the US does. But once you add in all the provinces, you get to a very ugly scenario. The bigger problem is you have governments on both sides of the border that don't recognize that they have a spending problem. They think they have a revenue problem. So it's only going to get worse because they don't see spending as a problem. And if you don't see spending as a problem, why would you rein in spending? They don't see the debt as a problem, because if they saw the debt as a problem, they'd stop with the deficit. So they don't see it as a problem. It's only going to get worse. They got to pay it. They got to pay it, which means they got to come after your stuff. They got to get it from you. Understand this. Every single penny a government spends has got to come from you somewhere. It's got to come from you somewhere. So if you have wealth, if you've been successful, if you've made the right decisions, worked hard, you've saved, and you have some wealth, you don't get to keep that. I left Canada because one of the arguments I said is the tax rates have become unfair and they won't stop. They're going higher. They're as ridiculous as they are, they're going to go higher. And what happened in Canada when they released the budget? They went higher. They went higher just on those who actually are successful. And Biden is suggesting doing the same thing. All these successful people, how dare they? How dare they? With the amount of debt, I see two things happening. Number one, central banks can't keep rates high. They simply can't do it. Not with the amount of debt, and not with governments that don't recognize that debt is a problem and don't recognize that spending is a problem. It will only get worse. You will only destroy these economies by keeping interest rates where they are. They're gonna have to do Japan-style central banking, which is run to the zero line, for no other reason than the country can't afford it. I think that is the end game. Unless we start electing responsible government who's willing to balance the budget and reduce the debt, it's not going to happen. But we have populist democracies now. We don't have responsible democracies. We have populist democracies where the population has gotten used to a lot of support from the government. Any government that tried to balance the budget and cut spending would never get reelected, and the next government would just undo everything, and they would win on promises of you get stuff, and you get stuff, and you get stuff, and we're going to go after this small group of people called the successful people. That's not going to stop. Central banks have no choice. They have no choice. They can talk about inflation all they want, but they have no choice. Otherwise, they'll destroy the very economies that they are, I guess, in charge of making sure that you have full employment. They will destroy the economy, and that will destroy inflation, but it's a terrible way to destroy inflation. So two things are going to happen. Debt is going to increase in both countries, which means tax rates are going to increase in both countries, and the central bank is going to have to go to the zero line. Okay, let's look at yields over the last week. Not bad overall. Money market rates all being well behaved because, well, we're not expecting anything from the Fed at all, so they're pretty much going to stay where they are week after week. Capital market rates increased, but not a lot, increased slightly. We still have curve inversion, the 2 to the 10s, but look at that. Down just 29 basis points now. You get a little bit more steepening on this curve, and you could be uninverted. It is a record inversion. I don't think it's going to uninvert. I think we're going to get a bull flattener this week with the Treasury refunding. The 3-month to the 10-year, because the 3-month is going to be locked basically where it is on monetary policy, while the 10-year will start to reflect higher for longer. Negative 0.79. That was over 200 basis points at one time. 531 days on that one. Canada even worse. Looking at the Fed balance sheet, down $3 billion week over week. SOMA runoff 3.52, so a rounding error, up $500 million. Money market fund assets increased by 9.13 billion. Retail by 211 million. Government is down, but prime is up. Institutions up by 9 billion. Both government and prime are up there as well. There was a huge drawdown in money market funds, and now we're starting to increase again. I said you can't read too much into that because we have the effect of taxes. In anticipation of the tax date, money gets moved into a place where, well, let it sit there and earn some interest, and then on the date that it's needed, off it goes to the Treasury. So that drawdown was probably just tax season, and now we're getting the regular type of bill that, every day corporations build cash. Every couple of weeks, consumers get their paychecks, and excess money goes into cash. It doesn't just sit in cash; it sits in money market funds. So heading back back to the $6 trillion mark. We have got a lot of stuff happening this week, along with some 160 S&P 500 companies reporting this week, along with how many other companies that are outside the S&P 500 reporting this week. It's a big week. And look at the economic calendar. FOMC, the big headline event, is in 3 days. The employment cost index for Q1 is in 2 days. You have ADP, you have the JOLTS report and ISM manufacturing in 3 days, along with Treasury refunding in 3 days. That's going to be a busy morning. Some economic data on the jobs front, some data on Treasury refunding, along with the FOMC. My God, what a day. Unit labor costs and productivity for Q1 we get in 4 days, and jobs numbers in the US and ISM services you get in 5 days. Basically, you get Monday to catch your breath. And then I think Monday's got like less than 10 companies reporting. And then every day, you're running through a hail of bullets, depending on how the numbers come out. Big week for jobs numbers and inflation, job inflation. You have the ECI, you have the ADP, you have JOLTS, you have unit labor costs, and you have the jobs report, just for the U.S., not for Canada. As far as yields go, Treasury refunding in 3 days, and you get the FOMC. And I think Yellen is going to do what she can to get rates down, to get yields down, being that they've got a lot of money. But by the way, when I say that the governments in both Canada and the U.S. don't recognize that we have a spending problem, they think we have a revenue problem. Revenues have never been higher. It's just that spending has never been even more higher, but revenue's never been higher. It's not a revenue problem. But being that the Treasury has significant funds right now, I think its refunding going forward is going to come in lighter than the market is expecting. I think it'll be lighter. And I think it's necessary because, she's in charge of the Treasury. She's seeing, we got to turn over this debt at these higher rates every single time. So that's going to be, I think she's going to do what she can here. I think this will be positive for rates. And then it depends on how Powell deals with this. I mean, he's said two things now. There was higher inflation, a couple of reads of higher inflation, and he says that doesn't materially change our stance. But then after that, he said, well, this could potentially change the way we're looking at rates throughout the year. So I don't know what he's going to say on this one, but that PCE number in Q1 GDP, it's not that great. However, that was an advanced look. It is usually subject to revision. Well, not usually. It is subject to revisions, and it usually does change. So maybe looking past that. I don't know. The market doesn't seem to think so. 97.3 of 0. I think that's right. I don't think you're getting a rate cut now. And only 2.7%. And I think that's just positioning. I think that's just hedging. I don't think anybody's actually betting on a rate cut in May. Canada, GDP preliminary number for March is in 2 days, and Meldrum speech is in 3 days. If you're in Canada investing in the U.S., man, you got a lot of risk. You got everything going on Wednesday, plus Meldrum, who's going to speak 2 times in case you didn't hear him the first time. And Fed speak in the U.S. Friday, Goolsbee and Williams, but after the close on Friday, so it doesn't affect markets. Going out to December 18th, more than 3 cuts, 1.5% probability, almost non-existent versus 3.3. And no more than 1 cut. So no cut or just 1 cut went from 50.7% to almost 60%. That there'll be only 1 cut by the December 18th meeting. The effective federal funds rate still locked at 5.33. Reverse repo back up to 464, an increase of 67 billion. Our lowest number that we're keeping our eye on here, 327 from April 15th. I think on Wednesday in the statement, you'll get a drop from runoff of 60 billion in treasuries down to 30 billion in treasuries with no change in mortgage-backed securities. Its cap is 35, but it's been averaging 15 a month. So there's no point in lowering the cap. They want to get rid of MBS anyway, so I think they'll keep that at 15, but they'll drop that to 30. TGA 929, week over week, small little $500 million. It's no big deal on that one. Their target balance is 750, so they've got some $180 billion to play with there. Reserves really dropped, 57 billion down to 3.21. So take the reverse repo and reserves, the excess liquidity, minus the 2.5, which is my number for what adequate reserves are, or ample reserves. You have a need to run off 1.23 trillion. If we assume 75 billion a month, 60 in treasuries and only 15 in mortgage-backed securities, you got 16 and a half months. I think they'd like to extend that out closer to 3 to 4 more years where they can run it off slowly over that period. I don't think they get to do that, by the way. I don't think they get to run off for another couple of years. I think they'll have to stop at some point much sooner than what they really think. But I do think that you will have a reduction in runoff for May, and sort of an unknown question mark for when the first rate cut is going to be. The FOMC meeting, the press conference, will set the tone, and this is every meeting we wrap ourselves up into the thinking of this is the most important meeting yet. And now here we are again. This is the most important meeting yet. Everyone is important. As long as the Fed is data dependent, the investor is data dependent, and we keep going from data point to data point to data point, and reacting at every single data point. It is getting tiring. Okay, not much movement in real rates, all edging a little bit higher. 224, 224, 224. I don't know if they did that on purpose. 224 over here as well. That seems like a nice number. And break-even rates all edging just a little bit higher as well. 244, 244, 243, all in a very tight range. Looking at Fed funds futures. Let's look down here. Q2 pricing in a 3 basis point cut, meaning that by the end of June nothing's going to happen. Q3 15 basis point cut. Maybe we'll get one rate cut in Q3, maybe not, so like a 50-50. And then Q4 16.5. So you basically got 34.5 by the end of the year. 1.5 rate cuts versus the last summary of economic projections, which was 3. We don't get a summary of economic projections this week. We get it at the next meeting. Still long Fed fund futures for December and January. I see no reason to move from that. Rates. It's not that rates will drop. Rates must drop. Rates must drop. Just given the sheer level of debt. Again, I've made that argument many times. I don't need to go through it again, but we are heading towards Japan-style central banking, I think. TLT gave up 1% last week. SPX advanced 2.67%. Implied volatility dropping a little bit on the sell-off over here. I tried for 85 puts, but I got no fill. I think I was like a dime away on what I was offering, and I thought the market would come to me because we had a nice drop going on. I thought, well, I'll just give it it started to rally again. I said, I think it'll revisit. I'm going to leave my price where it is, and I didn't get them. But I was really trying for the 85 puts at that point. Just a little greedy, and I didn't get them. But I am more than willing to sell puts here for the simple reason that rates must drop. Spending will go up, period. I always like to think, well, what do I know for sure? Spending will go up. Spending, there'll be deficits as far as the eye can see. Spending will go up. Deficits are now required for re-election. If you attempt to balance the budget, not by increasing revenues, but by cutting spending, you'll be a one-term leader because the population has gotten used to getting stuff, and you have to promise stuff. And you have to take that stuff from other people to give to people. That is that is populist democracy, and that is where we are at this point. It doesn't matter in the U.S. if the Republicans win, you know they're going to slash taxes. And maybe they will cut spending, maybe they won't cut spending, but they're going to run deficits. If the Conservatives win in Canada, I think they're not going to cut taxes. I don't think they're going to repeal the cap gains inclusion, because they have been asked that directly, and cagey answers. They're not going to say anything about that. They're going to cut some spending in some places, but they'll deficit spend, and as they get closer to an election, they'll deficit spend. It's going up. Okay, it's deficits as far as the eye can see, because it is required for re-election in populist democracies, which is what we have. And as a result, taxes will go up on success. And that will drive capital out of the country, which will decrease the revenue base, which will make the deficit wider, which will make the debt worse. There is no choice. Rates must drop. Okay, mortgage rates. 7.17 now. Last week, 7.1. Broke that 7 and still continuing on, up 7 basis points. Treasury was up 6. The fixed rate mortgage basically followed suit. Spread still sitting below 250. Kind of well behaved down there. New home sales for March came in at 8.8%. Pretty good. Pending home sales up 0.1%. These are month over month numbers. Tuesday, we get home price index for February and Case-Shiller. XHB down slightly week over week. The ITB down 1.5% week over week. ABR 1.6 week over week. I've not bothered to put all the other components in, all the home builders there within the ETF, so we're good on that. OAS is all contracted. Nothing to see here, no fear. Rather an uninteresting series at this point. In the housing sector and in corporate spreads, not a lot from week to week to look at, so that's why you got a lot of white space around here. The white space looks good though, doesn't it? Okay, I'm going to spend some time on Tesla's earnings, not because I'm really focused on Tesla per se, only because I wanted to spend some time thinking critically about some of the things that were said and some of the evidence that we can get from other places. And there has been some accusation that Tesla is improperly recognizing revenue, and the person that's accusing Tesla of doing that is calling it the greatest fraud perpetrated on the consumer. I don't know, but we'll look at what the claim is, and then we'll look at what the number was that Tesla recognized as revenue for that particular thing. And the person does have, kind of seems like they have a point, but I don't know enough about the feature to really be critical about it, but it does look like they have a point. But the amount that was recognized, I don't know, just to me doesn't seem to move the needle. Let's look at their earnings, and I don't think it's a surprise to anybody. They were ugly. If we just look at their earnings, they were ugly. And their guidance came with just a promise from somebody whose promises are, to begin with. So red here is year over year. If we look at total automotive revenues, just automotive revenues, and we'll break this down because within automotive revenues are different categories. Down 13% year over year, down almost 20% quarter over quarter. So here is the year over year down this column, and over here I put quarter over quarter. Energy generation and storage, quarter over quarter up 13.7%, but only up 7% year over year. Year over year is the better number to look at because it takes out potential seasonality that could have existed into the fourth quarter. Because we, 15, and it dropped to 14. There could be some seasonality, so 7%. Look at services and other revenue. Year over year up 25%, quarter over quarter up 5.63%. So we think, well, 25% growth, that might be interesting. We look at the gross margins there, they're almost non-existent. it ends up being a small contribution to gross profit. So total revenues, adding everything up, down 9% year over year. Total gross profit down 18% year over year, down 11% quarter over quarter. Operating expenses up 37% year over year. It was up 6.36% quarter over quarter. You have your revenues, total revenues down 9% with operating expenses up 37%. That's a question mark right there. In their presentation, they talked about all their costs going down. If you have a significant drop in sales, your operating expenses should have dropped along with it, or at least not gone up to that degree. Income from operations down 56% year over year, down 43% quarter over quarter. Coming down to net income attributable to common stockholders, down 55% year over year, down almost 86% quarter over quarter, and on non-GAAP down 48% year over year, down 38% quarter over quarter. And these arrows here are to show you how long they've been contracting. Gross margins 19.3 to 18.2 to 17.9 to 17.6 to 17.4. You don't get to keep healthy growth margins in the auto industry. Not given the structure of that industry, you don't get to keep them. And given the number of competitors Tesla has, and the number of aggressive competitors that it has, and the overcapacity that it's building in this market, you don't get to keep those margins. Looking at operating margins, 11.4, 9.6, 7.6, 8.2, 5.5. Those are operating margins you're going to find across GM, across Ford. They're there now, 5.5. Free cash flow, negative free cash flow at this point. Negative free cash flow 2.521. Net cash provided by operating activities, 2.5 billion, 3 billion, 3.3 billion, 4.3 billion, 242 million, down 90% year over year, and you have negative free cash flow. So your cash pile, cash equivalents gone from 29 billion down to 26.8 billion. Let's, when you look at this, it's ugly. I mean, it's ugly, but it's always about the future. Yeah, a company can report some ugly stuff, but well, what do they have going forward? So let's spend some time looking at that. Okay, let's break down the automotive revenue. 17,378 comes from auto, regulatory credits, and leasing. Auto was 16,460, regulatory credits 442, and leasing 476, all down year over year. Auto's down almost 13%, regulatory credits down 15%. This line item will eventually disappear. And leasing, well, I shouldn't say disappear, but it's going to be under pressure. It's going to keep dropping because more and more companies are producing regulatory credits. Leasing 476, down 15.6%. But these are small. I mean, here's the number, right? They do make a note of saying deferred revenue recognition was 281 million. So if you go year over year, last year Q1 was 134 million. It's 281 million. And they attribute in their presentation higher FSD revenue recognition year over year due to the release of Auto Park feature in North America. So an extra roughly $150 million of revenue recognition in Q1 because of that. And this is where one investor is screaming fraud because Auto Park was previously released, and according to Tesla's release schedule, it was released in 2015. So I don't know enough about the Auto Park feature to say, oh, well, hang on a second, though. In 2015, it was released on only these cars, but now it's released on more cars. I look at the extra 150 compared to 16.4 billion, and I think, it seems rather immaterial. But then again, I find this little bit of information, 2024-211. The feature they're talking about was released to employees only. and that the full rollout of it is not until August 4th. So February was the release for employees only. Everyone else gets it in August on the updates. So it's like, well, you know, I'm left with question marks there. If you're telling me those are the releases and that's who got them and that's when it's expected, you really didn't release it in Q1, did you? And if you had released it previously in 2015, which your website says you has, but again, there may be technical parts of it that I don't understand. I'm willing to let that go. But yeah, I'd say there's a couple of question marks right there. For the auto, cost of goods sold running at 84.42, 15.58% gross margin. And they did announce they were cutting 10% of their employees. If you look at GM, which has higher cost employees than Tesla, the cost of assembly isn't 10% of your cost of goods sold. It's significantly smaller. Most of the cost of the vehicle, 2/3 of that is raw materials, is parts, is the cost of actually constructing the vehicle. Then you have your depreciation in there. Wages end up being a small amount, so it's not really going to add 10% to their gross margins. You know, if they add 80 basis points or 90 basis points to their gross margin because of that, then as long as they can keep their prices, which it does not look like they can keep their prices. So there's the auto part, and okay, well, fine, we know the auto, the EV sector is under pressure right now. We seem to have a lack of demand. We're in that gap between the early adopters and the mass adoption. There's a lot of infrastructure that has to be fixed first. There's some range anxiety that has to be fixed. Everybody's having the same problem. It's going to get better. The smaller companies are going to fail. There's going to be some consolidation. At some point it gets better. We can look past that, maybe. Energy generation and storage, cost of goods sold 75.35%, margins running roughly 25%, but it's the growth is in there 7% year over year. And when we talk about energy generation and storage, you know, Tesla's doesn't have anywhere near a monopoly in that space. There's lots of companies that are doing that, but there is a problem with it, which doesn't seem, you know, nobody's really talking about it yet, but there is a problem here. You have to get a permit to generate electricity for your house. Now that may not sound like a big deal. Well, of course you got to get a permit. You want to put a driveway in, you got to get a permit. You want to take a tree off your property, you got to get a permit. So big deal, you got to get a permit to put solar panels on. It's not just a matter of saying, here's what I want to do, here's my permit, I fall within all the regulations, give it to me. I mean, when I expanded my house in Canada, I wanted to put in a pool, I had to get a permit. I'm going to get the permit. As long as I meet the requirements, I'm going to get the permit. It's not as if they say, oh no, there can only be so many pools. This is the thing with solar. There can only be so many solar panels. You may think, what's the deal there? Here is a region. Here is a utility that invests in CapEx to supply electricity into here, right? Well, if a whole bunch of people started getting solar, this becomes unprofitable. So you can't just build out all the solar you want. There's actually a limitation, and your application, after a certain point, your application can be denied. Nope, sorry, you can't. So, you know, the growth to me seems a little concerning. 7% growth. Services, cost of goods sold running 96.5%. The margin is really, really small. So if we look at the gross profit, the auto all in is basically what they are. So what are they here? They are an auto company, period. Energy generation and storage, 10.9%. That's a small number. And services, 2.19%. So when we look at this, we could say, okay, well, as of right now, they are an auto company. But the goal is, from what I can tell, to be more of a services company. That even on the conference call, Musk says, if you don't believe in the autonomous future, don't buy Tesla stock. And I agree with him. If you don't believe in the autonomous future, this is just another car company. Another car company that I don't think has a product line to compete with the Chinese manufacturers. Have you seen some of these cars coming up? I'm in Costa Rica, so I see a lot of Chinese cars on the road. There's a lot here. Nice looking cars. Nice looking cars. Tesla's inventory. I'll talk about China on the next screen here. Inventory up 17.67% quarter over quarter. 17.67. If we look at cash flow from operations, just for the inventory build, it was a drag on cash flow from operations, 2.7 billion in vehicles. IC cars looked at 1.8 million used cars aged 1 to 5 years sold between February 23 and February 24, because you have an inventory build in the first quarter. That's all the way up to February, all the way up to March. February 23, February 24, looked at 1.8 million used cars that were aged 1 to 5 years. Tesla had the highest year-over-year depreciation at 29%. You got an inventory build coming up over here. Could you potentially see some impairment charges on that inventory? If it going into Q2, the inventory build keeps going. The number out of China, this is not good. In the first week of April, Tesla, based on registrations, Tesla sold less than 10,000 in the first week of April in China. Less than 10,000. That is a big, massive drop. We haven't heard any news out of Tesla on how they're doing in China post Q1. But you have an inventory build. If this inventory continues to build, if you get more of a build, given what is going on here, you might be looking at an impairment charge. Tesla announced, yeah, we are going to introduce a low-cost car. And everyone said, oh, there we go, fantastic, up we go, up we go. Well, hold on a second. These cars are not profitable. There's a general rule in the auto industry: the lower the price of the car, the lower the gross profit and the lower the margin. It's not just the profit. It's not saying, well, okay, sure, a $25,000 car is going to make less profit than a $100,000 car. It's the margin. On a $50,000 vehicle, you might margin 15%. On a $40,000 vehicle, you might margin 13%. On a $30,000 vehicle, you might margin 8%. On a $25,000 vehicle, you might margin 4-5%. The margins get constricted. Now, this was a problem. Musk said no new capacity is going to be needed to introduce this low-cost product. That's a problem, because if you have that extra capacity at this point and you're going to substitute a low-margin product, that means there's no growth with the capacity you have. You're basically saying there'll be no growth for the higher margin product, right? Now, Ford in their quarterly conference call also announced a $25,000 to $30,000 EV. Ford's not profitable on its EVs. Tesla is. Doesn't matter. Doesn't matter if Ford's not profitable. If they put one out in the market, Tesla still has to compete with it. Even if Ford is not profitable with it, Tesla still has to compete on it. I made this point a couple years ago that Ford and GM can survive a price war on the EV side longer than Tesla can, because Ford has cash generating units, which are ICE. If you read their 10Ks, they do make that statement that they will continue to invest in EV and that they will use the cash, the serious cash generation from the ICE business to fund this in a more responsible growth way. They say that, but they do say we got lots of cash coming off the ICE side, and that'll be. I compared it to cigarettes 2 years ago. Cigarettes are a no-growth business, but they're a huge cash business because there's no CapEx. There's just no R&D. There's no CapEx. It's just pure margin. Same with the ICE now. Why would you put significant CapEx into that? It's a cash generator. I don't know what the excitement was about announcing that you're going to introduce a car with extremely low margins and that you're going to use the existing capacity you have, basically saying that we can't see this capacity being used for the higher margin vehicles. I don't see what the excitement was. The Other side of this is you could say, well, hang on a second, you're missing the point. This is not about making money on cars anymore. This is about the installed user base to sell services on. Okay, great. Cost of goods sold, 96.5. But you're missing the point. It's going to be about robo-taxis and autonomy. That is decades away. That is not next year. That is not at the end of this year. That's not next year. That's decades away, and everybody is working towards that. 2 years ago, I said that everybody was pulling up a chair to Tesla's table. Everybody was pulling up a chair, and they have, and they will continue to do this. Tesla is not alone. They're going to have competition. They have competition, and the competition is going to get worse. Let's just look at what's going on in China. Okay, over to China. I'm doing the video now for the auto industry, so I'm coming across a lot of really great information, a lot of great sources for information. The China Association of Auto Manufacturers report that the average profit margin in China is about 5%. That's what you're competing against. You're competing against companies who are willing to operate at a 5% margin. The National Development and Reform Commission, the market will be in a state of oversupply for a long time. Total market for 2024, they forecast at 26.8 million vehicles. Total manufacturers target production 30 million. So they will have to boost exports, and most of this production are sub $30,000 vehicles. Pretty much where Tesla is saying they want to introduce something, they're going to introduce it into a market with significant overcapacity, with significant oversupply, and the market, look at the state, will be in a state of oversupply for a long time, and these manufacturers are willing to operate at 5% profit margin, and they are going to be boosting exports. So there's going to be massive oversupply in China. There'll be more than enough supply to meet demand, and some of that's going to have to go somewhere else. All of that competes with that sub 25,000. You are, I think, rushing towards a low margin, low profit product. So if this is what if you're a car company, I don't see this as exciting at all. So the excitement must be because, well, it's the installed user base. You're going to sell services onto this. Careful, this is a cheap vehicle. This is a low-priced vehicle. You're going to try to cram all of that technology into a low-priced vehicle so that you can overlay all of those services later on, all of those cameras, all of that computing, so that you can then download those services to the car later on. That car has to ship with the ability to accept those upgrades. I'd be very careful about that. The M2, Model 2, this is sort of the code name, or the name, for lack of a better name, being given to the $25,000 vehicle. This is what Musk said on the call. It's coming late this year, early next year, so I have a bit of an outcome. It's not coming when promised, because it's been promised for 3 years. It's not coming when promised. He says it's coming, but he says a lot of things are coming. I don't know why the market just doesn't discount that now, but it's either it's not coming when promised, or it will not be what is promised. In other words, it'll just perhaps be an M3 that is decontented. Decontenting is a word that I came across, and I thought that's an interesting word. What does it mean? It means to take an existing car and take out its content, remove things, strip it down. Don't build a whole new car. Just take an existing car and make it cheaper. Decontent the car. In other words, you're trying to get to a minimum, the minimal viable product. How much can we take out to get it to that point? To get it down there, if you're going to decontent an M3, you're going to take out most of the technology needed to make it the robotaxi, because you got to ship it with that. If you wanted to do all these new features coming up, you have to ship it with the capability to accept all of that. That costs money to get done. The other outcome is it's just simply not profitable, and I've given some percentages here. Not coming when promised, or it's not going to be what's promised. I give that a 50-50. Either one. Either it comes when it's promised, but it's not what was promised. Either he stays true to the timeline, but it's nowhere near what he said it was going to be, or It's not going to happen this year or early next year. It's not going to come when it was promised. And I put a 90% probability that it's just not going to be profitable, because you're going to have to compete with all these China brands. You're going to have overcapacity. You're going to have an increase in exports. You're going to have a significant price war on that front. You're going to have to make that car cheaper and cheaper and cheaper. Yeah, I don't think it's going to be profitable when it does come. That space is already getting very crowded without a Tesla in there. You can say, well, that's the power of the brand name. Does the brand have the same cachet that it used to have 3-4 years ago? I don't think it does. All of this is just, being a little bit critical on the valuation of Tesla, not on the product, but on the valuation. I'm skeptical of a robo-taxi in the next year, or in the next, he says August 8th will introduce something. He might introduce some pictures of what a robo-taxi might look like and some screenshots of what a ride-hailing service might look like, but it'll be nowhere near able. You have to get the municipalities to agree to let this happen. That's a big fight to have. Then you got to get insurance companies willing to insure these vehicles. That's going to be a big fight as well. This is a decade away at least. I think that its proper market cap is somewhere under $100 billion. I don't understand the rally in the stock. I don't understand the absolute willingness of investors to say, okay, it's coming. This reminds me of Beyond Meat when it was 150, 160. Every week that announced, partnership with Yum Brands China. Big headlines, and you'd read it and you go, okay, so you're going to have 2 products in 3 stores for 4 days. This is not a partnership. This is a market test. That's all it is. It's not a partnership. But man, they were good at producing headlines and keeping the dream alive. And investors, every headline, that stock would pop $5-6 every time. And well, eventually, nothing came from it. Look where it went. I said 2 years ago that Tesla would suffer from the gravity of the industry they operate in. They cannot escape the economics of the industry, and they will get there. I am surprised at the willingness of investors to just go along. Oh, it's coming at the end of the year. Oh, we said it's coming at the end of the year. Oh, we said robo-taxis in August, and off we go without any critical thinking on this one. That it's not just Tesla. It's the entire auto industry that is looking at doing this, and not just looking, is currently doing it. If you look at the Chinese brands and you look at the amount of technology they're putting in there, look at the Huawei car. Huawei has a vehicle out, looking good, and the technology that is in there, the amount of support that China is giving its local producers. Much like Chinese steel and Chinese solar panels being dumped on the world, I would look for Chinese cars being dumped as well. Now, some countries with domestic production will try to protect their industries by erecting trade barriers, but other countries that have no domestic production don't care where their cars come from. And they have no domestic production. They'll import whatever they can import, and if it's a cheaper car, they'll do it. I think we're underestimating the amount of supply that the Chinese firms are going to be absolutely willing to dump on the world. I think we're really underestimating that. Okay, let's have a look at SPY. Forward 4-quarter operating earnings on the S&P 500, 503 on the SP 503, because there's 503 companies in there. LSEG and SPGlobal, take the average, use the closing price. Forward multiple of 20.31. This is Q2 of 24 all the way to Q1 of 25. 20.31 times forward earnings versus 19.8. Surprise factors dropped week over week down to 9.5. So if we use the 9.5, it's 18.55. This will continue to drop, I think. I don't know what it gets to, but I think it continues to drop. Implied volatility dropping just a little bit. The initial uptrend that we had has been broken, and if you drew a new speed line here, You do have support, an upward support line, so you can say, well, the bull market is still intact. We do have a downward channel, so you do have kind of a pennant flag formation beginning to form here. All-time high sitting at 522.95, way up here, 522.95. 50-day moving average 511.08, closing at 508.69, just slightly below the 50-day moving average. 200-day moving average 467.82. I am looking to short beta. I'm back in. I was indifferent on it because the market just kept performing and performing. The multiple just kept going higher. AI, and you know, you don't want to stand in the way of that. But higher for longer, if that narrative really begins to take a hold, and it does start to play out, and the Fed makes that mistake, I think that would be a serious policy mistake. I just can't see, given this curve inversion and the record length of this curve inversion, how you can avoid a hard landing. It's just a head scratcher, and usually when things are a head scratcher, there's usually reversion to the mean where you say, wow, okay, I mean, why didn't we see this? I mean, all the signs were there. Just right now it seems to be avoiding it. So I am willing to go back in and short beta, and I will. I am watching the 50-day moving average. We have a run up to there. I think I'll take my first position there. For the week coming up, SPGlobal says 165 companies are reporting. LSEG says no, it's 175. Sector Spider says it's 166. I think we can say, hey, it's a lot of companies reporting. I am puzzled. I don't know. I am puzzled. Anybody from any of these companies, if you're listening to this, help me understand why this is so hard. I am puzzled why you can't get this number right. I can't figure out how you can't get this number right. And you want to charge a lot of money for other numbers that you create, and you can't even get this one. You know what? I bitched about this last week. I see it again today. I'm bitching about it again today. I'm thinking, but it just seems to me this is an obvious thing. Anyways, let's have a look at some of the companies that are reporting. There's a lot of them, but we'll go down a list. Okay, I'm just using SPGlobal, and I've just ordered it alphabetical so that we have it all per each sector. So it's not in calendar order, it's in sector order. You can go to the sectors that you want. Noticeable ones this week: Amazon Tuesday after the close. Some other interesting ones: Yum Brands, eBay. If we go down to, I believe, information technology, we should find Apple Thursday after the close. You also have AMD in there as well. On Semi will be an interesting one. They had a rough go of it a year ago, dropped like $20 on their earnings and their guidance, dropped to low 60s, $60. I thought it was a buy at that point. They've worked their way up to $67, $68, and they have earnings on Monday before the market, so there's no time to position for that one. Real estate, American Tower, that's interesting. Boston Properties, as far as office in primary cities, see how they're holding up. I did read that in New York City, the demand for office space had increased quarter over quarter, month over month, something like 20%. Well, that's an interesting statement. But you have a lot of real estate companies, and then utilities if you're into the utility space. With the growth in data centers, especially the AI data centers, I don't know if you've been hearing much about this, but the amount of power that they need, especially just in cooling, just to cool those places, is you know, like the power consumption of a small city for one of these data centers. So let's see what utilities have to say about the growth of the data center. Anyways, I don't know which earnings calendar is right. Who knows? But there's a lot. Let's just say there's a lot. I think the big story is the economic calendar. Wednesday, keep in mind, you have both the Treasury refunding and the Fed.